Greetings, my beloved clients and friends. I been wanting to do this video because there's a lot going on in the world with the banking crisis that we've experienced in the last week or so, and so I wanted to talk about that, but the weather hasn't cooperated for me to go on a hike. So I'm going to try to do this while I'm driving. I saw someone else that I watch videos of, and he does it when he's driving, so I'm going to see how that works. So on Friday, the government seized the assets of Silicon Valley Bank, and over the weekend there was another bank too that got taken over. So what happened, and should we be concerned about it? So I've mentioned before the 3-6-3 rule of banking, which is borrow at 3, lend at 6, and be on the golf course by 3, right? And if you understand that, it'll go a long way to understanding what's going on. So banks borrow money in the form of deposits. When you put your money into a checking, savings, or CD account, you're effectively lending your money to the bank. They're borrowing it from you, and they're paying you interest. All right? So, on average, over the last 100 years, bankers have paid about 3% for that money that they borrow. Now, in the last decade or so, the rates have been much lower, right? You get nothing on a checking account, maybe 0.1 on a savings, and 0.5 to 1% on a CD. So banks have been able to borrow that money very cheaply, right? Borrow at 0, and then they could lend it at 3 or 4 and still be on the golf course at 3, right? So that's been the situation for banks for the last decade plus, until recently. Okay, so and then what do they do with that money? When you deposit it in the bank, they don't just store it in a savings in the vault for you, waiting for you to come get it. That money is being put to work. That's how they're able to make a profit, because they borrow it from you at 3%, they lend it at 6%, and then they could be on the golf course at 3, right? So they make money on their spread. It's called a balance sheet business, and if they could lend it out or invest it at a higher rate than they could borrow it, they make it's a really nice business. And borrowers are happy because they have access to credit, and depositors are happy because they have a safe place for their money that facilitates payments for whatever they want to do. And the banker's happy because he's on the golf course by 3, right? So as long as that system is in a normal situation, everyone's happy. But some problems could arise that would affect that system, right? So they invest that money, and they got to make more than what they pay you, right? And normally that's possible because normally the cost of money is higher the longer you go out, right? So if you invest your money for 30 days, you expect to get a certain rate. But if you invest it for a year, you expect to get more. And if you invest it for 5 years, you expect to get more because of the time value of money. If you invest it for 30 years, you expect to get more. That's the normal upward sloping yield curve, right? So banks borrow short and lend long. They borrow from you, and you could come get it tomorrow if you want to. So that's a short-term loan, if you will. And they lend it long. They'll go out and do a 30-year mortgage or a 5-year auto loan, right? And so they would expect to get more on the investment because one is longer term than what they pay you. Okay, so And when rates are really low, like they've been over the last decade, it was real easy for them to make more than zero on their investment, and that's all they had to make to have a positive spread. Okay, so that's what the banks want to do. They want to borrow at a low rate, lend it out or invest it at a little bit higher rate, and then be on the golf course at 3. Okay, so what can go wrong? There's 3 main things that could go wrong. Number 1 is that the money that they invested, let's say it doesn't make the 6 that it needed to make, or it didn't make the return that they needed it to make, or it went bad, right? They lent money to someone to buy a house, and that person was not able to pay them back, right? That happens sometimes. Sometimes they make bad loans. They make bad loans to a business. The business can't pay them back. They make investments that don't work out. So they're very careful about how they invest and how they lend. But even with all the precautions, sometimes, some of those loans or some of those investments go bad. So they have provisions, but if it's more than they expected for whatever reason, they could have a problem. So that's one problem, that the investments don't pay what they thought they would pay. The second problem that could happen to banks is that the depositors want their money back all at once, right? Because what happens is the depositors put their money in and they don't all ask for it at once. And so the bank notices that, money comes in, money goes out, but there's this big pot there that's left over at the end of every day, right? So they're able to invest your money that you deposited at the bank, and as long as a bunch of people don't ask for it at once, it's not a problem, right? The money comes in and out at a regular pace. They're able to satisfy all the demands of the people that put money in, and they're able to invest that money without any big hiccups. So, but if all of a sudden a bunch of people ask for their money at the same time, they might not have it to give to them. That'd be called a run on the bank, or and then there's a little bit of a problem. So the government has this FDIC insurance that said, don't ever worry about that. Up to a certain amount, we will make you whole if the bank has that money out invested and they can't get it to you in time. Okay, that's FDIC insurance. It's for deposits, because deposits do have that unique risk in that the bank was not just holding it for you, they were out investing it. Okay, so the first risk is that their investments could go bad. The second risk is that the depositors could ask for their money all at once. And the third risk is a inverted yield curve, right? Because they want to borrow at 3, lend at 6, and be on the golf course at 3. And if they're borrowing short and lending long, usually they can invest for higher than they could borrow, right? But what if the yield curve is inverted? What if they borrow at 5, meaning they pay you 5% for your deposit, and they could only invest it at 3 because the long end of the yield curve is lower than the short end? How can they make money borrowing at 5 and lending at 3? Right? So an inverted yield curve like we have right now, that the rates on short-term money are higher than the rates on long-term money, is a very difficult environment for banks to operate in, right? You might be excited because all of a sudden you heard, oh wow, I could get 4.5% on a CD at the bank. And this other bank is offering me 5%. I haven't seen those rates in decades. That's great. I could finally make money on my savings again. Okay, that's good for the depositor, But is it really? Because what that means is if the bank is paying you 5%, they need to turn around and invest that at 8% to be able to be on the golf course at 3. Right? Where are they going to find an 8% investment that's liquid and secure and not taking a lot of risk? There aren't any. So when you demand the bank to pay you 5% on your CD, you put them in a very difficult situation, actually, because now they got to go out and invest that at a higher rate. And so those are the 3 risks, well, 3 of the big risks of banking. 1 is that their investments could go bad. 2, depositors could ask for their money all at the same time. And 3, an inverted yield curve where they can invest at a higher rate than they borrow safely, right? Well, guess what happened to Silicon Valley Bank? All 3 at once. They had some investments that went bad, and they realized that they had more deposits than investments because the value of their investments had gone down, and now they had more deposits than investments. And banks are very regulated. They're not allowed to do that even for a day, right? So they had to raise money very quickly to make up that difference. Well, that's Silicon Valley Bank. Their customers are investors, are venture capitalists, and founders of companies. Largely, it's very concentrated into who their depositors are and who their customers are. So they have a very, you could say, investment savvy base of customers. And when Silicon Valley went to go raise capital, guess what? Their depositors knew about it that same day. And they're like, why is this bank raising all this money to shore up their balance sheet? Is it possible that there's a problem with their balance sheet? And that was Wednesday of last week that Silicon Valley raised this money. I mean, really quickly, they went out and they raised this money. On Thursday, some of their depositors didn't feel good about that and went and bought and took their money out of the bank as a precaution. And the word spread, because Silicon Valley is really a small community. Hey, I'm pulling my money out of Silicon Valley Bank. I'm concerned that their balance sheet might not be might be under some duress. In one day, Thursday, $40 billion of deposits went out of Silicon Valley Bank because their depositors knew what was going on. They had, unfortunately for them, they had very much in the know depositors to the point where they had to stop. They were able to satisfy the requests of the first 40 billion, but they got to a point where they didn't have the money to give out anymore, and they had to deny requests of people wanting to take their money out of the bank. Right, so the problem started because they had an inverted yield curve scenario. It created some of their investments to go bad, and which resulted in depositors wanting their money all up on one day, Thursday of last week, right? So all 3 things that the risks that a bank could have, or the 3 big risks that the bank could face, Silicon Valley faced it in a very short period of time. Now, why was that? Why is that? Why did they get in such a bad situation so quickly? Well, they don't have a very diverse depositor base. They're in Silicon Valley. They bank to Silicon Valley businesses for the most part. And those startups, they raise money through the venture capitalists. So the venture capitalists have their money there. the venture capitalists give that money to one of these startups. And so let's say there's companies just coming out as very promising, and they need $5 million just to keep the doors open while their business opportunity matures and gets to a comfortable scale where they're profitable. So investors will invest, say, $5 million, and with the expectation that that company is going to use that money for their operations and spend it down over the next couple of years. And if the business continues to do well, they'll give them another $10 million for another 2 years, right? And if the business doesn't do well, they lost money on that investment. But so there's a lot of risk in that business, but there's never the expected risk that that money that I deposited in the bank that investors gave me all of a sudden is going to be gone because the bank had a problem, right? Those startups face a lot of risk, but that's not one of the risks that they expect to face. But that's what happened. They couldn't get their money that they used to pay payroll and pay rent and pay all that stuff. All of a sudden they couldn't get their money. So Silicon Valley Bank, because they had a unique set of depositors, it kind of made the problem worse for them. But the problem of an inverted yield curve is not unique to Silicon Valley Bank. It's a problem that all the banks are facing right now. And so that's what gives me some concern, because here's what happened. COVID came, it shut down the economy. The government and the Fed threw a lot of money into the economy in a very short period of time to keep it going. A lot of money, trillions, I think 10 trillion. And where did that money end up? Well, first it ended up in banks. So banks got this massive influx of cash in the form of deposits from all these people that were getting money from the government, right? Silicon Valley Bank, for example, that bank went from, I think it was 60 billion in assets to 200 billion assets in 2 years. That was the extent of the influx of capital into that bank in a very short period of time. Okay, so it might have been exaggerated there, but that was happening to banks across the country. In a very short period of time, their deposits were going up rapidly, and they had to invest that money. Good news is they didn't have to pay their depositors anything because interest rates were zero. Depositors weren't expecting any kind of return. So even if they could invest it at 2 or 3%, they were making positive spread, right? So they could just invest it in a government bond, which is the safest thing, not even have to make a loan or anything, and make positive spread on that money. And that's what they did. They bought a lot of government bonds because they had that positive spread compared to a zero on the deposits. Well, but they invested that money for 5 or 10 years in government bonds. But guess what? In a very short period of time after that, a year later, now they're having to pay 3 and 4 and 5% on deposits. And it's not new money that they're getting in. It's the same money that they already have that people are coming in and saying, oh, I'm taking it to the bank across the street because they're paying me 3. So on their same money that they already have, now in order to keep it in the bank, they have to match the bank across the street. So they thought they were only going to have to pay 0% on that money, and they went ahead and invested it long term at 2%. Well, now on that same money, they have to pay 3 or 4 or 5, and they're upside down on those investments. Right? It's not the money they're making on the investments is not covering what they're paying for those same deposits now. The other thing that happens to bonds, if you buy a 2% 10-year bond, that means, and let's say you put 100,000 into it. This is what the banks were doing. Obviously larger numbers than 100,000, but just for illustration purposes. So you buy a 2% 10-year bond. That means that $100,000 bond is going to pay you $2,000 every year, and then in 10 years you get your $100,000 back. So over 10 years you're going to make $20,000 in interest, and then get your $100,000 back. Okay. Now, let's say you had to sell that bond, and rates are still 2%. Well, someone will pay you $100,000 for that bond, and they'll say, "Yeah, I'll get the 2% for the next 9 years." And you might even make a little bit on that bond, because now it's only a 9-year bond, which a 9-year bond's a little bit better than a 10-year bond, right? So in a normal environment, you might be able to sell that bond for a profit if you had to, or at least get your money back, right? But what happens if now you're trying to sell that bond and rates are 6%? The 2% bond that you bought a year ago is only going to pay you $20,000 over the next 10 years, right? Someone today could buy a 6% bond because rates have gone up, because Powell jacked up rates by 4.5%. So now rates, that investor could now get a 6% bond, and over 10 years he can make $60,000. Why would he want your bond that's only going to pay him $20,000 when he could go out in the open market and buy a bond that's going to pay him $60,000? No one is going to be at all interested in your bond, because your bond's going to pay him $40,000 less. The only way you could sell that bond is if you offer it at a $40,000 discount. You can say, "Yeah, I know you're only going to make $20,000 on my bond, but I'll sell it to you for $60, and when it matures, you'll get that $40 back, because it matures at $100, right?" That's what you would have to do to get rid of that bond that you bought in a 2% market, and you're trying to sell it into a 6% market. Okay? So the bankers that had bought those 2% bonds, they know that their money in those bonds is not worth what they paid for it. It's worth much less, right? And if they have to sell that bond, they're not going to be able to get the 100 that they put into it. They're only going to be able to get 60, right? So even if it's not a Silicon Valley bank or a business bank, or if it's a bank that took in a lot of deposits in 2020 and 21, and they put a lot of those deposits into bonds that were earning a low interest rate, those bonds that they invested in are worth less today. They're worth much less today, especially if they're 10-year bonds. They're worth much less. So as long as they hold them to maturity, there's no problem. And so when the Fed and the Treasury say, "We're going to backstop those banks. If you need to take your money out, we'll make sure that they have it," because they don't want to force the banks to sell those bonds in this environment. They want to let them hold on to those bonds till they mature and they get their full amount, right? So that's why it's so important that the government steps in and does not force those banks to sell their bonds into this environment. And so by the government doing that, it really helps the banks. And not helps the banks meaning keep those bankers richer. It means helps the banks meaning that you, the average Joe, as a depositor, don't have to worry. They're really protecting the depositors from not being able to get their money out of banks. So in a normal environment, money comes in, money goes out, people borrow, people invest, people lend, right? at normal paces, everything works fine. What happens was when they shut down the economy, and then they throw a ton of money into the economy, and then they jack rates way up. That messes things up. It's like if you're when you get in a car, or you put a 16-year-old behind the wheel for the first time, right? They don't know the movement of the vehicle, and they turn the steering wheel too hard, and they push on the gas too hard, and they push on the brakes too hard, because they haven't learned it. It only takes a little bit of movement on the steering wheel and a little bit of adjustment to the gas and the brakes to make this thing work just fine, right? But if you jerk on the wheel, you're gonna create a problem. Or if you slam on the brake or slam on the gas, you're gonna put yourself at more risk. So I guess I could say that the banking system in the US, because of those jerky movements that have happened in the last couple years, the huge influx of capital and the huge jack up in rates, followed by which was preceded by the shutdown of the economy. Those three massive jerky movements have made it very difficult for banks. And if banks start pulling in their horns and not taking deposits, or not making loans, or not making investments, or being hesitant to make loans and investments, that does not bode well. So even with the Fed backstopping it, we want our bankers to walk around confidently. We want them to be on the golf course at 3 and feel good about what they do, and business as usual, right? If our bankers are not confident and are not wanting to make a lot of loans, or they're operating in an inverted yield curve environment, that's something to be a little bit concerned about. That's why I'm in my car doing this video when I'd rather be doing it outside on a hike, because it's important, and it's something that is going to make us much more cautious as investors. So I don't just want to say, hey, don't worry about it, everything's fine. We should be making precautionary. We should be taking precautionary measures in this type of environment, and we're going to do our best to make smart choices, not out of fear, but as an abundance of caution, and maybe a little bit more conservative in the portfolio until we see how this plays out. We want to make sure that the banking system is healthy, so that the rest of the economy could go on as business as usual. So I just wanted to give you an update on what's going on in the banking. Hopefully that explains what happened, and give you some assurance that we're doing what we can to make sure you're not overexposed to risk. Okay? So I hope you guys have a great day.